Hello, students of Learn History with Thomas Sir. So, I am your educator, Mr. Thomas, and today I am going to teach you the third unit of Max Mutual Funds and Equity Shareholders. Shares and mutual funds can also be, we can see to this lesson, shares and mutual fund. So shares, in this what we are going to cover in shares concept, face value, market value, dividend, equity shares, preference shares, bonus shares. And in mutual funds, we are going to learn simple problems on calculation of net income after considering entry load, exit load, change in the net asset value. Net asset value is about the change in the total value of a pool of shares. What we can say about mutual funds? Mutual fund is a pool of investors in one pot. So four quadrants of. Next, we are going to learn the four quadrants. So four quadrants is income, economic benefits rate are received by the business economics from any economic business. Business earning are received by from any economic activity. For example, operating income and non-operating. Operating income would be that we earn by doing the business, and non-operating income would be from which we either earn from some other way. That is comes in P&L. Expenses, financial obligation, whether it discharged or not by business earning from business purposes. Operating expenses, non-operating expenses. Operating expenses that happens while you do the production. Operating expenses would be the example I can say is the electricity charges. Non-operating expenses would be which occurred indirectly to the operating expenses. Assets. Now that given future economic benefits FEB to the business earning, which is returned to control the B. Current asset is less than 12 months or 12 months. A non-current asset is more than 12 months. That is 1 year. Current assets are 1 year, less than 1 year, and non-current assets are more than 1 year. Liabilities, present financial obligation not yet discharged by the B. This is expenses. That is, current liabilities would be less than 1 month, 1 year, 1 year or less than 1 year, and non-current liabilities would be greater than 1 year. So now next is the income statement and balance sheet. We are going to learn this. So income statement and balance sheet. In income statement, we start with the sales from trading account minus COGS. COGS is cost of goods sold, that is minus from sales, and the gross profit is found. Then after that, minus the admins and sales and demand expenses. It is minus an operating profit, that is net profit we get. After the minus the non-profiting income or expenses, for example, non-operating expenses would be the salary, something like that. Earning then that we add a minus, and then it would be the earning before interest and taxes. That would be paying to bank a loan, bonds, or equity, loan bonds or and taxes of the government. Then we minus the interest. Then it would be the loans or bonds, and then our earnings before tax. In the earnings before tax, we minus the tax. Then we earn the EAT, earnings after tax. Net per after tax. EAT, NI, NPAT. There's other. You can say it in any other form. Then we minus the preference dividend. Preference we pay to our preference shareholders. Then it comes the income available to ESH, equity shareholders. That is EPS, equity per share. Then minus equity dividend. Equity dividend is given to the equity shareholders, who is known as the owners of the company. Then after that, it is minus, or the remaining is retained earning that we write it towards the balance sheet in the liability side. So equity share capital, 8% preference share capital, reserves surplus. The remaining money, the retained earning is also the reserves and surplus. Then the non-current liabilities, current liabilities, the total liabilities. As we know, fixed assets. In the asset side, there is fixed asset, long-term investments, current assets, inventories, prepaid expenses. These are all the income and income sheet and balance sheet. The share capital versus shareholders share investment. Tata Steel, equity share capital, 8% preference share, reserves and surplus, non-current liabilities, current liabilities, total liabilities, fixed assets, long-term investments, current assets. Then balance sheet as well. So this the share investment. After we invest the shares of Tata Power 127700. Here we don't have, we have not written this long-term investment, that is shares of Tata Steel 1,27,700. This is a long-term investment. What is the difference between face value and market value? Face value is nominal value or legal value printed on the security by the issuer. For example, 1 rupee, 5 rupee, 10 rupee, etc. Market price determined by the marketplace, buyers and sellers. Marketplace is basically our stock exchange. National Stock Exchange, Bombay Stock Exchange. Few famous examples are National Stock Exchange, BSE, NSE. Then we have Foreign Stock Exchange, New York Exchange, and there's America. Then we have the London Stock Exchange. So these are the examples. Then we can see there is share capital, equity or preference share. Face value into number of shares is the share capital, and market value or market capital is market price into number of equity shares outstanding. Then we have the market ratios. These are market ratios from equity shareholders view. Equity analysis. We can using this we can analysis any stock or any what will the future price, what will be the future returns, what we receive from the payment, what the investment we have done. First is shareholders return percentage. So how it is found? CGS, capital gains plus dividend divided by total investment is shareholders return percentage. Dividend payout ratio is DPS upon MPS, dividend per share upon earnings per share. Then the third is dividend yield, that is dividend per share upon market price per share. Book value per share is shareholders equity minus PSU minus PSC, preference shareholders, and divided by number of equity shares. That is the book value per share. Earning yield, that is EPS, earnings per share upon market price per share. P, price earning ratio is equal to market price share upon basic earning per share. Note, basic EPS and dilute EPS refer to ES. EPS and basic EPS are synonymously used. Although we have always used the BEPS, not diluted EPS, because we basically use the EPS. Market to book ratio is market price per share upon book value per share. So the shareholders return, and so we are going to see the first sum. I'm not able to enlarge or digest. Let's see how can I do it. So you can see this shareholders return and dividend yield. Mr. X purchases 150 shares of Asian Paints Limited at rupees 30 on 1/4/2020. The following information is provided for the Asian Paints Limited for the year ended. Particulars: earnings before interest and tax 2 lakhs minus interest 25,000. So the earnings before tax is 1,75,000, then minus tax at 40%, that is 70,000, that minus the earnings after tax is 1050. So second, Asian Paints Limited outstanding preference share capital of 1 lakh, on which dividend at the percent of 7 was paid. Also, company paid a equity dividend of rupees 3 per share. Total number of equity share outstanding is 500 as on 31st March 2021. Find out the following. So first we have to find out the shareholders return for Mr. X if market price as on 31st is rupees 45. How did you get this 45? As we know, 3 rupees per share is 0.60. So that is rupees 45 is 0.60%, 60%. Then second, how did you find? I will teach you all. So shareholders return for X is total capital gains plus total dividend upon investment. So 2250 is the total capital gain plus 450 is the total dividend, and upon 4,500 is the investment. As we have seen here that 150 share into 30. 3 paisa. See, this 4,500 is 150 into 30. And as we can see, total investment came from the 7% and all. And we will going to learn the dividend yield. For DPS, dividend per share is rupees 3 upon market price per share is 45. So for 3 divided by 45, that is 0.066 or 6.67%. So next, shareholders return holding, that can also be called as holding period returns or historical returns. Mr. X purchases 100 equity shares of Tata Steel on 4/2/2022 at rupees 1,277 per share, carrying face value of 10 from the market. The price of those EAs is close to rupees 1 1455 on 4 to 2024. When he sold the equity shares, he also had received dividend of rupees 10 per share. What is the total percentage of return on shareholders? So shareholders it is total capital gains plus total dividend into 100 about total investment. So total gains is, as we can see, is what the capital gain is 17800 plus total dividend is 1000 divided by total investment is 122,700 into 100 we get the 14,700 14.72%. So this is the shareholders, analyzed shareholders, adjusted shareholders, and now we are going to see the annualized share. Mr. X purchased 100 equity shares, the same as it at the rate of 1,277 rupees per share, carrying face value of rupees 10 from the market price of the those years close to that would be rupees 10. And when he sold the equity shares, he also had received dividend at rupees 10 per share. What are the annualized return of the shares? So the annualized total capital gain is 17,800 plus total dividend is 1000 upon total investment is 127700. That is 14.72%. Then annualized shareholders is that into 365 divided by 12. That would be 7.4%. So dividend payout ratio. Now we are going to learn the dividend payout ratio. Dividend payout ratio is find out using the income available to equity shareholders minus the equity dividend and retained earning. So sales minus cost of goods sold. So the basic formula of the dividend payout ratio is DPS upon MPS, that is dividend per share upon earnings per share. So earnings per share is income available to ECH upon wins, and DPS is equity dividend upon number of shares is equal to DPS, dividend per share. So we will find out how to learn gain the dividend yield. So dividend yield is equal to DPS upon MPS. So DPS is dividend per share. The equity dividend, this is equity dividend upon market price per share. That would be different at different times. Let's see one sum of it. The dividend yield ratio is calculated by which one of the following? Earnings per share divided by dividend per share, dividend per share divided by market price per share divided by dividend per share, and dividend per share divided by earning per share. So it will be dividends per share divided by market price per share. So next P ratio application. We learn about the P ratio. Which one of the following statement is about the P ratio is coming? Company high growth P ratio is ordinarily high as P is more, meaning the firm has lost. When P is more, meaning when the firm has profit. So P ratio is MPS upon EPS. Maximum earning per share. So abnormally low, and so the correct answer is A. A company has high output ordinarily has a P. So next price earning ratio. Information concerning headlines is presented below for the financial year ended May 31st, 2005. Equity share 7,050 and stats is 50, value is 50 rupees per share. Market price per share is rupees 45. Year dividend per share is 4.50. Second dividend is paid per share is rupees 7.50. Basic earning per share is 11.25 and diluted earning per share is rupees 9. The price earning ratio is, as we have learned, EPS upon base. The total would come to 45 divided by the base upon EPS, that is 45 and that is 5%. So next dividend yield. It is a sum on dividend yield. The corporation annualized earning of rupees 12. It is divided a payout of 40% and an annualized dividend of 4%. The stock price per share must be DPS upon FPS, that is dy equals to DPS upon FPS. DPS is here is 40%, that is at 12. So we will see that comes to 11,120 rupees. Backed off P. Question. A steady drop in the firm earning per ratio could indicate that the basic earnings per share has been increased while the market price has held steady. Now the P ratio calculation. Reported net income of rupees 5,88,000. The company has 10 shares. 1,000 shares are added par value. 6% of the preferred stock is 1,20,000 equity shares and of rupees 10 par value, and there are no dividend payment in the areas in the market price per share. Common shares at the end of the year as rupees 40. So Apple seed price earning ratio is E80 after earning is 5880 is equal to 60%, 60,000, that equals minus 60,000, that is 5,28,000. Then minus the divided by the NAS, that is 12,000. That comes to 58.16 per share. That EPS comes to 4 rupees 4.4 per share. So we will know the P ratio, that is MPS upon EPS, that is 40 divided by 4.4, that is 9.09. That would be the correct answer, would be B. Now next, P ratio. Devel has 2,50,000. 2,50,000 shares of 10 per value equity shares outstanding for the current year. Devel paid a cash dividend of rupees 3.50 per share and had earnings per share of rupees 4.80. The market price of dividend stock is rupees 24 per share. The dividend price earning ratio is 7.08. How it came, as you know, 34 divided by that is 34 divided by 34 is the market price per share and earnings per share is 4.80, that is 7.08. That is option is answer B. Option B. So next, book value per share. You can see the financial statement. You have to learn the book value per share. So 29 lakh divided by 50,000, that is rupees 19.33 would be the book value per share. Then the book value. I'm going to learn. Book value would be 230, that would be the 52 plus 18 plus 5. This is the 50 lakh 50 lakh plus 1 crore 12 lakh plus 60 lakhs is equal to 2 crore 30 lakhs. That is divided by the by 10. That would be 23. So that is the answer is B, 23. The 5 rupees per share to 10,000. That is the 50. This is 50 lakhs. The market price to book value ratio. The common stock is 1 lakh, 10 lakhs, and there is additional paid up capital 20 lakhs, and retained earning is 500. So the market price per share upon book value per share. Yearly total will be payout will be 30%. No shares was redeemed during the year. Trading in the market to the book ratio is expected to price share of it. So the market price is 2 equals to market price. It's not given to 3.2. The market price is 7. So 3 lakh 35 lakh divided by 10 lakhs, that is book value per share is 3.5. So now the dividend yield. This was the most financial year. Okala Inc. paid a regular quarterly dividend of $0.20 per share and is earning the $3.20 per share. The Okala stock ended at ₹40 per share. So dividend yield was 0.8 by 4, that is 2. So how did we get it? Twice 40 is the 2, 0.8, that is 2. Okay, so direct earning yield EPS upon EPS. So we need to find the EPS. EPS is 3 divided by 3 divided by I will be showing you the calculator. 3 divided by 80. The answer should be 0.666. The correct answer is D, 18.66. So it's effect on MPS. So increase in the market price of the company will immediately affect its dividend yield, basic earnings per share. So the book value per share is represented with the equity as a common share. The market price is greater than the indicate of the overvalued share. Here we can see that market price per share is in the dividend yield is we are the DPS upon MPS. DPS here is 1 rupee divided by market per share is 60. So we can see here differences with 1 divided by 60, that is 16.667, or 1 divided by 50, that equals to 0.06, 16.60, and 1 minus percentage. Just 0.01 and here is 0.02, just 2% and 1%. You can see Arnold dividend 20 is year 2. So we can see that has declared compared to year 1. 60 was the market price at year 1. Book value it has declined compared to year 1. So next, P ratio. The following information concerning the annulled company common stock with the equivalent P is NPS upon EPS. EPS minus NPS. This we have calculated. P ratio. We are going to EPS upon EPS. So we are going to learn. I will be using a calculator for it. Yeah, we are free to use calculator in the exam, so it is not a big deal. So we are going to see EPS upon NPS upon EPS. NPS is 650 first year, 50 divided by base upon EPS. Then earning per share is 3. 50 divided by 3 equals to 60.66, and 60 divided by 3 equals to 20. 60.60 is 20. So which is the greater year 2. So business investor would likely to consider equal shareholders, so positive trend growth opportunity in the year 2 compared to year 1. So I stop this here and I will continue the remaining portion in the second part. So thank you guys. You like, share and subscribe.